Hi, this is Randy Finney with Right Side of the Chart, and today is September 1st, Thursday, September 1st, 2016. Starting this video about 10:40 a.m. It's actually the second time I was almost through this video and had a technical snafu, so I want to get this out as soon as possible. I'll try to cut this one a little bit shorter and just hit on the big bullet points, and we'll go from there. Time permitting, I'll touch on gold and the mining stocks at the end. There was, we had some big miss on the ISM numbers this morning, and that caused an immediate plunge in the dollar, which immediately spiked gold because gold is, dollar cents when it wants to be. That's a funny thing about this market in the last year or so is that there are times where there's gold is absolutely could care less what the dollar is doing, and then today, when the ISM numbers missed, dollar fell sharply and gold had a almost exact inverse move to the upside. GDX followed, so we'll touch on that if we can. Mainly because GDX is an active short trade, and we reversed just shy of the first target today on that. So we'll get to that if there's time, and if not, I'll cover that in another video. Not to spend too much time on this. Starting out here, we're on the S&P 500 daily chart. This is a 2-year daily chart. And for those of you not familiar with it, I'll just touch on what I've covered here. Back in 2015, we had a series of 3 consecutive divergent highs. Divergent high number 1, 2, and 3 is labeled here. Each divergent high in itself produced a correction. When I say divergences, for those not familiar, I'm talking about prices making higher highs against your indicators and oscillators down here, making a series of lower highs. So you had divergent 1, which in itself led to a correction. Divergent 2, correction 2, divergent 3, and these were the waves down the correction. We really didn't, the market didn't bottom till we got here. So what you have is if you have 3 consecutive divergences, even though you had a correction with each one, you have immediately another divergence, and they're all coming off that same peak. Essentially, that just gives you one larger divergence, really. So that's what you were looking at, this one large divergent high. And the same thing has happened here recently with these 3 consecutive divergences. So we peaked there, and where I was bearish or back in July when we had this divergence forming, then confirmed later in July, I was looking for a correction, and as time goes on, the larger those divergences became, I'm looking for an even larger correction. Now we'll see what happens. I'll give you my scenarios here. Um, and I'll give you my 2 primary scenarios. The more bullish of the 2 would be a pullback, and I put a couple lines up here. This top line is just marking, see the 2015 highs back here. We had two highs roughly equal back in 2015. And I'm sure that most eyes or most expectations are a back test of the 2015 highs at worst, and then a move back up. Now, from my experience, breakouts to new highs. Too many eyes are watching that level when you have breakouts to new highs. So from my experience, you'll usually see us come back in, or I think we'll come back in down below to about that 2120 level. I have a few reactions there that define that level. What that would do, it would be a little bit of a fake out move. It would shake out some of those people that are stepping in to buy at the 2015 highs back test. It would probably suck in some shorts when they see that fail, and then there's some energy to squeeze out those shorts if the market can reverse from that point. So again, this would be the more bullish of my scenarios, and I can easily see this happening, and that would then take us up, to new highs and beyond. It would be healthy. It would help reset or at least work off some of these overbought conditions. It would help these divergences play out. And again, so where we go from there, I'll talk on that if that scenario begins to materialize. The other scenario, which I'm equally as open to, if not more, is the fact you'll probably see at least a reaction somewhere in here between the 2015 highs and that 2120 level. But a reaction meaning either a pause, like a consolidation, we trade around for a few days, maybe a couple weeks, and then a breakdown, or a bounce. That's what a reaction. I define that as you come down, you hit a trend line, you either stop, or typically a bounce, maybe a minor bounce, and then a breakdown. Now that would be very bearish. because I can't see any reason, technically speaking, looking at the charts, if you're on the bull camp and you think this market we're in a new super or new bull market. Let's just say you're of the mindset that the last couple years was a large sideways consolidation within a larger bull market that worked off all those overbought conditions, allowed valuations to catch up to where they should be. And now this breakout was the launch of a new leg that's going to take this bull market up 20, 30, 50. I don't know what the numbers might be. If you're of that mindset, then there really isn't any reason, at least I can see, technically, why the market should go much below 2120. Therefore, if it does, I'm very much open to that possibility. We can start to see one of these very impulsive sell-offs like this, where the market then realizes, hey, something's going on here. You see a lot of longs exiting, and that will probably coincide with everything I've been talking about for months now, the fact the economy is clearly rolling over. The Fed is out of bullets. They've used all the arrows in their quiver. They'll jawbone. That's all they've had left for the last year or two is jawboning, which is talking the market up or down by threatening some other extra monetary action, some type of more quantitative easing, whatever they're going to do. But we all know that the effect they've had a diminishing impact, on the markets. So I think the Fed, well, whatever. Let's just not get into that. I just don't think that the Fed. I've maintained that all along. I won't completely dismiss the effect the Fed can have on the market, but I am very, very, very strongly believe that ultimately the market fundamentals will dictate where the market goes, and that the economy and the stock market along with it go through in business cycles. And the last 7+ years we had extreme attractive valuations because of that flush out in 2008 into the 2009 lows, and we've had a recovery since then, albeit a very sluggish recovery. And this part of it was really where the bull market should have went, and a lot of this was due to the zero interest rate environment. Fundamentally speaking, that those pretty much free money that the Fed's produced, corporations can borrow at next to nothing, and they borrowed that money to do share buybacks and everything else. It boosts their share prices. In addition to the fact that the Fed has forced the hands of safe money buyers, pension plans, granny who buys CDs from the banks and treasury bills. They've had no choice but to move their money into junk bonds, preferred stocks, and other dividend-paying stocks, and that's also exacerbated this move. So that's why we've seen such a move, and it looks like this market may have topped out, and only time will tell. So let's not spend any more time on that right now. Those are my scenarios. Again, looking for a pullback to ideally the 2120 level, and I'll gauge the nature of the pullback as it comes. One thing to consider, depending on your outlook for the market, when you believe, if you are short coming into as we approach these highs, and you're a swing trader, not a very active trader, you don't care to try to micromanage the trades and catch all the bounces. Instead of booking profits as we get to this level, you may want to just lower your stops to protect profits and let it ride just in case that level goes. And we do have one of these quick downdrafts. These are where the big profits are made. This is where the big money is made. I know early in the year, we were short on each of these rips down, and we were long at the bottoms on each of these two bottoms. Did I capture all the move up on both of them? No. And we're short here, long at the bottom, posted covering, and I admittedly missed on the long side for the most part, the bulk of the post-Brexit move. But since then, the market's gone absolutely nowhere. So, you can't catch them all. But what my point being is that if you've been shorting the market recently, looking for a pullback, it's been very frustrating. Just as if you've been longs and shorts alike have gone nowhere. I've already gone over that. There's no reason to spend any time. Since early July, the market as you can see here, has absolutely gone nowhere. It's gone up a couple percent, down a couple percent. So both longs and shorts alike are frustrated as a whole. I'm speaking in general terms. You can trade sectors, gold, you can trade something else. There's always something going up or down. But as far as a broad market and the majority of stocks, we've seen an increased rate of failures on breakouts on both the long and short side. And so as we have on the site, we've seen more trades stopped out and a lower success rate than I can recall in the history of the site. But on the flip side, I've kept the stops on the I've kept stops relatively tight because of that. And I think a big move's coming. And my point being, if you've had a tough time lately on your trades and you've been stopped out and you think a big move's coming, you might consider extending to those higher profit targets if you're booking the quick profits because you're conditioned at this point. The market's been so tough. Okay, I'm going to take profits at T1, the first target level, even though there's 3 targets on this trade. If this starts opening up to a nice downside move, you might want to consider extending some of those targets. And it's not uncommon that I will extend price targets on a trade, long or short. If the trade plays out and the market or the sector that trade is in, the charts are confirming, I will usually extend my own personal targets to the final target, and I'll often extend those price targets, add additional price targets, whether it's long or short. So I just wanted to point that out. In other words, in trading, cut your losses, let your profits run. And there are times, such as a sideways market, until we break those levels I've talked about over and over. We're going to get into those. Well, let's go ahead and jump into that. Let's look at the Qs. I've been harping on 116 for a long time. This is a key support level. You can look at, let's just shade this area up here and show you what I'm talking about. Here's our trading range going back all the way back to early August right here. This is the trading range that we need to break above or below. The divergences that I've gone over this many times over. We have negative divergences. We had them back here. No, I'm sorry, not on the Qs. I mentioned that not on the Qs. We got a rising wedge without divergences. We've had divergences from this point right here. We started building. This was a divergent high. And we did have a little blip. We had a little pullback. Market went higher and higher. I want to make this very clear. Just because these divergences have not resulted in a correction, not only doesn't mean they're not going to work, they've extended. They haven't been taken out. By taken out, we haven't seen the MACD or the 1333 histogram, the RSI move higher. We've only seen these divergences grow more powerful. And what that does is increases the chance that with a correction, if and when it comes, will be that much more powerful than it would have been had it had this level broken. This trend line back here, this rising channel on the Qs, when we had this first divergent high right here, you can see the peak in the, no, I didn't mean to move that line. You can see the peak in the MACD, the histogram down below, the RSI. Let's say that had broken. That would have, my expectation back then would have been at this minimum target. Now, my expectation is still this minimum target. However, we're going to fall from a much higher level when 116 goes. I mentioned this on the site yesterday. These aren't hard levels. You can see we've had a couple pierces. We pierced it this morning. First of all, it's a 60-minute chart. Therefore, a sell signal will be on a 60-minute closing candlestick. Ideally an impulsive candlestick. For those not familiar, this is an impulsive candlestick right here. This is somewhat impulsive. There's an impulsive green candlestick. These are not impulsive candlesticks. So you want to see impulsive selling and also confirm with above average volume. So what it would look like, I'll try this screen draw tool. This is going to be a white line. Just imagine this being a red line. You see big candle. You see a big red candle down here. The next candle, maybe you see prices try to punch up a little bit and then move back down. That candle's finalized. Another red candle down below. That's impulsive selling, guys. This isn't impulsive selling. These are just whipsaws. And as I often state, if you're trading the broad markets, which I have absolutely no broad market shorts on right now, officially or unofficially, if you're trading the broad market, you don't want to trade the Qs in a vacuum. You don't want to trade IWM in a vacuum. You want to look at all of them together, especially these two, the large caps, QQQ and SPY. The Dow only has 30 stocks. Forget about the Dow. Watch these two, the S&P 500 and the Qs. I mentioned 2530 is a key support level On the SPY, you can see the trading range, same all the way back to July. So there's your trading range. We had one little whipsaw signal there. And so I think it's safe to say that once 25.30 and 116 on QQQ go with conviction, those impulsive candlesticks, we're going to hit those minimum targets in probably relatively short order. But until and unless that happens, the trend is sideways. It's not up, it's not down. So if you're impatient, then I can tell you you're in the wrong profession. You can't squeeze water from a rock or blood from a stone. You can't extract profits from the markets when they're not there. Traders don't make money when the VIX is down at all-time lows and volatility is, and the Bollinger Bands are pressed to levels that they haven't been in many years. Nobody makes money in this market. I don't even think the high frequency traders are really doing anything now. You usually see these periods like this, and then next quarter, the big firms will come out announcing the banks, the financial institutions with trading desks. They'll say, oh, well, trading profits, earnings took a little blip because our trading profits are down, especially in corrections. They do good in these upside, these markets. This is where the high frequency trading machines gun the market and do well. All right, I'm digressing. Let's get back to the Qs. Those are the levels. We're flirting with it now based on the fact that we had a double divergent top here, double high top, both divergent highs. As I mentioned on the site recently, my trend indicators for the first time since all the way back here, we had a blurb, just a slightest whipsaw signal, but this is when this was our last, back in early June, June 10th, when my 60-minute trend indicators on the Qs went to a sell signal. We had a blurb there, so if you want to say late June, if you want to count that as a buy signal, it was really a whipsaw signal. And point being, all the way since June, the end of June, we have not had both of these. I use these in conjunction. I always state that. The signal line, the 9 EMA, and the 1333 histogram crossing below zero, and we haven't had both. We had a little blip here right there, but the MACD signal line failed to confirm. So this is it. You can see my sell signals right here, and that's on the trend indicators, but price hasn't confirmed. And price is more important than trend indicators. They just help confirm a trend, keep you in a trend. But as I mentioned before, price is what I'm paying attention to, and those are my levels on the SPY and the Qs, especially that QQQ 116. So there it is. That's what I'm looking for, and let's see what else to cover here. Here's the ISM manufacturing numbers I told you. This you can access this on the front page of the site. The economic calendar is on there. A link under Tools of the Trade. The expectation, the consensus was for a reading of 51.3 to 53. We came in at 49.4. That's a big beat. And if you notice down here, let's see if I have this. I don't have a highlighting tool already pulled up, but it tells you down here in the description that readings below 50, anything above 43, below 50 indicates that the U.S. economy is still growing, although the manufacturing sector is contracting. So we have a contraction, and as you can see here, a clear downtrend in the ISM. In other words, here, let me try to draw it out for you. You can see these waves, if you will, but this is a series of, a downtrend is defined by a series of higher highs and, a downtrend is a series of lower highs and lower lows, and that's what we're seeing so far here. Here's your highs, 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 lower highs so far, and your lows, 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 lower lows. So you can see that's dropping off. The trend is down, and that's been all the way back to 2013. This shows you as well here. You can see the trend. This is an uptrend. Higher peaks, higher troughs, and since then we had this high here. There's your high, lower high, and the lows are lower, and we're headed down. So clearly the economy is rolling over, and that is, in my opinion, extremely dangerous at a time we have such high valuations as well as bearish technicals. So if you're bulls, you're saving grace as well. What this did is it took the Fed rate cut off the table, or at least really I don't believe that the Fed. I believe the Fed is powerless to control the business cycle. They can manipulate the market, and they certainly juice this bull market. But for anybody that thinks at this point in time, in the year 2016, we finally gotten to the point where the central banks are now omnipotent. They now have finally figured out that magic recipe to prevent all future recessions and keep the stock market climbing indefinitely at their power. I think that's delusional thinking. Again, this has been, I cited the reasons why the market's gone up. I know myself and a lot of others underestimated the scope of this bull market, and what an impact a recovery in the economy coupled with low valuations coming in 2009, as well as all those share buybacks and all that would have. This has been the slowest recovery in history, and yet, one of the strongest bull markets in history. And God, man, there's so much I could go into here. The scariest charts to me, and they're very long term, and again, I'm digressing away from the shorter term outlook, which is what I wanted to talk on here, but I jumped over to a monthly chart of the S&P 500. This goes back to the 70s, the mid 70s, or 1977 back here, at which point we really started this super secular bull market. The mid 70s, for those of you familiar old enough, there was this period of stagnant markets had really lousy returns, and this is where things really ramped up. And this is, a secular bull market, and each of these bear markets we remember, those are called cyclical bear markets. So you have a secular or the larger overall trend being a bull market, and then within that secular bull market, we have cyclical bear and bull markets as we've had. And so this most recent one is simply just a cyclical bull market within a larger secular bull market. So, all right, that's pretty much simple. I think anyone can get that concept and is aware of that. Now, what just scares the heck out of me going forward, not scares the heck because I'm actually very comfortable, as comfortable trading on the short side as I am on the long side, but this chart says a lot to me. Let me move some things over here real quick, get these out of the way. This is the same chart, same time period, going back to 1977, of the 30-year Treasury bond index, Treasury yields, TYX, government Treasury bonds. Most of you are familiar, and if you're not, overall, one well-known correlation is stocks do well in a falling interest rate environment. Stocks do poorly in a rising interest rate environment. Those of you old enough to remember, or if you're not old enough, you probably learned this in school. Interest rates peaked right about 1980, 81. This is where interest rates peaked. Treasuries were yielding. I remember I started as a broker at Merrill Lynch. I had in the early 90s, I had clients coming in with, 15, even 17% Treasury bonds. And then I went over, worked at a bank, several banks as a broker, and I'd have people coming in redeeming 12, 15% CDs. I kid you not. And those were taken out, back then, if you had a long enough term CD. So the point being is, I just showed you the bull market, and I talked about that correlation with interest rates, that falling rates are good for stocks. Well, where are we at now? What happened during, I just showed you that secular bull market in equities. Look at this secular bear market in treasuries. If you think that's a coincidence, trust me, it's not. Now, we all know where are we at right now? We're at a zero interest rate environment. These are 30-year bond rates, the 30-year treasuries. You can go back, you can pull up 10-year treasury yields, 5 years, 1 year, whatever. You're going to see 1-year treasury T-bills paying, virtually zero right now, or next to zero. In fact, some countries we have a zero rate. So, and we all know, you read enough about this, they can only take, the U.S. hasn't gone to negative interest rates yet, where some European countries, but they talk about there's only so much downside you can go where money will just quickly leave the banks and start going under mattresses into gold and all that. Central banks know that. You're not going to see a negative, 5% interest rate. So I just want to say that this is it. The stock market is, the longer term outlook. I don't see how Now I'm talking longer term, 10, 5, 10, 15 years. Um, Sooner or later, we'll begin a new secular bull market in interest rates. Now, we can stay low for some time being, but most of the benefit, most of the juice has been squeezed out of these low rates. We've been at these low rates for a while. So longer term, um, we have valuations at historical highs and interest rates with nowhere but up to go from here. So that's it. And I digressed again. This is nothing that affects the trading right now. The 116 level I'm watching on QQQ or any of the active long or short trades on the site. More of a secular thing and more of an FYI where I think that it probably at no point in recent history has it been more important than no technical analysis. Um, and be comfortable with sector rotation and trading and things like this, because I'll tell you, the financial industry, the buy and hold, which has just worked so well in the last few years, all this money going to these indexed funds, the S&P 500 index tracking funds, passive investing, because the active managers aren't, for the most part, cannot beat or even match the performance of the overall market. What happens when we start a new secular bull market in interest rates and a new secular bear market in interest rates? And for those of you that say, well, that's not going to happen, stocks always go up in the long run, Randy. Well, let's look at Japan. We all know Japan. They implemented their zero interest rate policy. They were really where we were years back with their credit bubble, their housing bubble, everything that popped here in this country in 2007. They implemented their zero interest rate policy back in February 1999, and you can see the back here. And sure, they juiced the market. Absolutely, zero interest rates work, and that this is a monthly chart going back for decades. So this is a period of over a year and a half. However, didn't work out so well. Then we had this is a secular bear market is what I'm trying to get at. Here's a cyclical bull market within it. Cyclical bear market. Bull, bear. Bull, bear, or deer market, sideways market, and bull market. And they're still not even back to where they were at the peak of their bubble. You can see that here's the top of the Nikkei back there around 22,657 back all the way in 1990. Yeah, middle of 96. So they're still not even there yet. So they're still in that secular bear market. They may have come out of it, but I just wanted to point that out for those of you that say, oh, well, don't worry, you buy stocks. And this isn't inflation adjusted. I mean, you could you've seen pull charts on the S&P 500, which you say, oh, well, market just made new highs. Google this, just go, I don't have one in front of me, but you can do an inflation adjusted return for the S&P 500. That says when you back out inflation, in other words, the decline in the purchasing value of the dollar, the S&P 500 is not at new highs. You haven't made any money in stocks in the U.S. market in decades. So that's that. All right. Let's see if there's anything else to cover. Now, I'll wrap it up here. I touched on the Qs and the SPY, these 60-minute charts. Like I said, I'm jumping all the way from multi-decade monthly time frames down to the 60-minute time frames. And again, all that bear speak of what may happen over the next 5-10 years, that doesn't concern me today. Tomorrow as a swing trader. It'll affect some long-term investments, but even then, you go by the charts and you can navigate. You can profit extremely well in a bear market. The last bear market was extremely profitable for me, and I can't wait for the next one. So bull markets, bear markets, the charts will tell you where to go. There's always sectors that go up when stocks are falling, and there's bull and bear markets anywhere at any point in time. So let's watch this. Watch for what I mentioned, those impulsive breaks. As I said, my minimum target, each of these are levels. You've seen this in static form, this chart on the site. These are support levels where a reaction is likely. But I do think it'll probably bring us down here to this minimum target of 110.70 before all is said and done. And whether you want to cover, reduce positions there. I put these levels. Let's just say, well, Randy, okay, you say you think the market's going to 110.70. I agree. So how do I trade that? Well, it depends. If you're a armchair investor, a part-time trader, you work a full-time job, you don't have time to try to micromanage these trades. What you do is when you see, if you want to short the markets, I'm still not putting that as an official short trade idea. I prefer individual stocks and sectors, especially in a sideways trade and sideways market. But if you do that, you wait for that, maybe a 60-minute close, a solid 60-minute close below that 116 level, or an impulsive break. You can get in early if you see a breakdown and a lot of volume coming in and some impulsive selling, and we're more than just a few pennies below 116, especially if you have that confirmation on the SPY. And then what you do is after that point, you set a stop loss order, you know, maybe above this previous reaction high. You can draw a downtrend line here. Let's draw that downtrend line. So there, extend that downtrend line out. That could be your stop. It could be over this previous reaction high or the one before that. It's all about risk to reward. In other words, if you just want to target a quick pullback and you want to shoot for that 114.12 level, set your buy to cover order just above it, maybe 114.16 or so, and then you have to calculate your stops using a 3-to-1 RR. It's not a drawing tool. I can't draw that out. I was trying to draw 3-to-1. Same with that 1070 level. So you look at the 1070 level. Well, how much is it on the downside? It's from 116 down to 1070. That's not giving me what I wanted. Let's try to delete that line. Sorry for this. All right, so from 116 to 1070, this is what I wanted. That's almost 5%. So you give yourself maybe even a better than a 3-to-1. Give yourself a 1% stop loss. That puts you up about right over that previous reaction high right here. And you set it and forget it. And I mentioned to somebody the other day, I've mentioned this several times on the site, OCO orders, one cancels another. So immediately when you take the trade, you set your stop to trigger there with an order on the other side, a buy to cover just above 1070. That level's the actual support level, so you want to cover a little bit above that, maybe 110.82. And an OCO order, one will cancel the other. So either your stop gets hit first, which will cancel that buy to cover order down there, or your buy to cover limit order gets hit and the stop's canceled. And the other thing, as I mentioned about letting profits run, if we get some real ugly selling, we're watching key stocks, the leading stocks, Apple, Alphabet, Microsoft, Amazon, all breaking down below key support levels. At that point, you might decide, hey, I'm going to hold out and see if we can get one of those waterfall sell-offs. And so as we approach 110.70, maybe I'll lower my stops down to just above one of these former support, now resistance levels. There's 112.69, so you put a stop around 113.09, somewhere around there, and you let it ride. Worst case scenario, we bounce hard off 110.70 in reverse. You get taken out for a stop, and you still made roughly half your profit target there. But it opens the door for a whole lot more. And then at that point, you can continue to lower your stops as you go. All right, this video has gone on long enough. In fact, a lot longer than I wanted to, but hopefully it helps kind of give you the bigger term picture, the near term here, what we're looking for. And then I'll touch on gold and GDX in a separate update. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.